Welcome back to Left Anchor. I'm Alexi the Greek.
And I'm Ryan Cooper. Just been looking at my stock portfolio, of all the stocks that I possess. I have many of them. And, they've been sort of going up and down, kind of a seesaw thing. No, I lie. I don't own any stocks. But I was curious about the markets today. And so I thought that I would ask Mr. George Pearkes to come on, a guy who knows about this market shit. And so, George, can you introduce yourself?
Hey, Ryan. I'm George Pearkes. I am the macro strategist at Bespoke Investment Group. I write about global financial markets and economics for a living. Awesome.
Yeah, just the kind of person we need to have to make sense of this. A baffling day. The markets have been crazy. And I think this has been the craziest day of them all. And at least if you're trying to tell some sort of a straightforwardly rational story about future profit expectations and the efficient markets hypothesis, one of my favorite hypotheses of all the ones that we've heard about over the years. But little background just to set us up. So Trump took power. The markets were jubilant. Everything was popping. Tesla was up to like 1.4 trillion market cap. Since then, there's been a bit of a slide. As of this morning, stocks were down to like 15% from the high. But over the last week, Trump introduced this tariff formula on Liberation Day, which turned out to be, as I recall, it was like the trade deficit in goods divided by imports, so basically they claimed it was a retaliatory tariff based on what tariffs were being charged, but also including other things, which basically just was, the half the tariff in goods. And so that's why Lesotho, which is a desperately poor country that is in fact surrounded by South Africa, got like a 50% tariff because they don't have any income. They don't buy any video games or iPhones or things like that. So those were going into effect today. And then of course, this is a classic Trump experience. As I was writing an article about the situation, Trump abruptly came out and said, wait, no, the retaliatory tariffs are finished. We're getting rid of those, except for the ones on China, which are going up way higher. And so we've been going tit for tat with China. Now they're up to 125% tariff. But Trump's keeping the 10% tariff across the board on everyone else, which is really high and may or may not, I'm still unclear on this part, be keeping tariffs on Canada and Mexico of 25% and tariffs on automobiles possibly of 25%. And in response to this, markets boomed. Last I saw the S&P, you can correct me on this, George, but the S&P was up like 10%. The NASDAQ was up like 12%. One of the biggest percentage gains, in the history of U.S. markets.
10th best day in U.S. market history. So we have data it's reconstructed prior to the 1950s or 60s, but S&P 500 data goes back to 1928. And this was the 10th best day. The only other times you saw bigger rallies were during the Great Depression, during the huge sell-off in stocks after the Roaring '20s, which lasted like basically a decade, and then during 2008. So not the market made a low in 2009, so it was on the way down, and that's how these things tend to go. You tend to see the biggest rallies during the biggest sell-offs, and we got one today.
Yeah, and so I guess that's my first question. What the hell is going on? With this, like it seems like I was looking, Walmart and Amazon were popping like, 4, 5 something odd percent. I don't know what the figure is, but like they're up a lot. And those two companies in particular are going to be killed by the 125% tariff on China. I don't know how many of their products come from China, but I would guess it's like a majority probably. And like those will just not be available, I would assume, at that level of tariff.
So you'd be surprised at how much sourcing Walmart does domestically. I think the figure they tout is like 2/3 or 75% domestically sourced.
Huh.
Now there's probably some funny math going on there, but a lot of the stuff they sell is sourced domestically. A lot of it is sourced overseas. Either way, 10% rally in the stock today. Walmart, the way markets tend to work is there are these narrative sort of themes that go on. So Walmart is viewed as it's in the industry called consumer staples. These are the kind of places where people continue to shop and spend money even when times are bad. And these are sort of grocers or food producers or companies where it's really, it takes a lot to sort of turn off the spigot of spending in a permanent way. And Walmart had dropped quite a lot before today. So it made its high on February 13th. And then dropped about 22%. So underperformed the market over the last month and a half, basically. So, when you see these big moves after stocks have already come down a lot, I talk about this a lot. The biggest rallies come when stocks are down the most. And there are a few different reasons for that. First reason is that the market's already thinking negatively. So when you get any positive information, that has like a lot of leverage on how people are thinking about the future. Changing the outlook from bad to a little bit of good news, stuff pops. And that's not just about big macro stories like the one we're talking about right now. It's true for companies when they're going through a rough period that's specific to them. It's true across other asset classes as well. It's true for the broad stock market. The other thing is when you get a big decline, you tend to get people positioned very light. So people are either outright short or very, very low long exposure. This happens very quickly. And the sorts of pools of capital that set prices at the margin these days move very quickly. Whether it's pod shops, which are basically big hedge funds that have a bunch of different strategies all under one hood, whether it's hedge funds, whether it's other sort of more active investors, these folks tend to have very, very small risk budgets and move very quickly. So when you see a big new piece of information, you get a big reaction. And that was what we got today. Earlier this week on Monday, there was a poorly sourced headline that was attributed to Reuters, proposing that Kevin Hassett, who's the chair of the not the chair of the Council of Economic Advisors. He's a senior economic advisor to the president. He was attributed to have said, well, we're thinking about a 90-day pause on tariffs. The White House later denied that, and Reuters and CNBC got into a bit of a spat over who had actually tried to report this. But the market just took it and ran with it and went up 6% in a matter of like 30 minutes, I think 15 minutes. So clearly earlier this week, we were primed for good news. If we got any good news, the market was going to fly. And that's what happened. To sort of take a step back and finish up my monologue here, markets are human systems. They're composed of people. They have constraints that you can't always see. And they're not perfectly efficient. They're not perfect discounting mechanisms. They're very good at processing information, but they're fallible, just like human beings are fallible, just like any other human system is fallible. So whenever you see a huge move in the market or a move that just doesn't make sense, my thing is always, what don't you know? Because you probably don't know something that's important. And this stuff does not happen randomly. It can be hard to attribute, but it's very rarely random. And so that's sort of, I think, a good summary of where we're at today.
Real quick on that, just to follow up on like, how much of the response do you think is, as you say, maybe people that were shorting the market saying, oh, we better recoup those gains before it goes up in response to this news, and trying to like, enjoy the success of shorting the market or shorting a stock before he paused the tariffs? And how much is it people that are like, let me try to buy the dip before it goes back up? And how much is it neither of those, but people actually thinking, you know what, he's not really going to do the crazy thing. Maybe the market's not going to actually keep going in the wrong direction.
We don't know. I mean, there's no way to attribute
who knows, right?
Yeah, there's no way to attribute it specifically. We can look at positioning at a lag, and various different Wall Street banks put out positioning estimates based on their client base. So, for instance, a prime broker will put out an estimate based on their clients on where hedge funds are positioned. we can see flows into ETFs. We can see volumes, but this is all sort of groping around in the dark to get at the real question. Yeah. And from the perspective of setting the prices at the margin, it doesn't matter if someone's short and covering. So in other words, they're short the market and they need to buy stock to cover that short and close out the position. Yeah. Or if they're sitting on a bunch of cash underinvested and saying, I don't want to miss a rally. Mechanically, these are going to have the same effect, which is stocks rip. And I think, seeing what we saw on Monday and then seeing markets trade today, I don't think anybody should be surprised that we got the big walk back. It wasn't actually a walk back if you calculate the percentage of imports that are exposed to which tariffs at this point, but it felt like a walk back, and it was him climbing down, especially to those countries that had those sort of punitive, quote unquote, reciprocal tariffs equal to 1/2 of the trade deficit with the United States divided by imports to the United States. So before this announcement, as of last Wednesday's announcement, if you took 2024's import values for all the different countries we imported stuff from, this is just goods imports, not services, and you apply the tariff rates to those 2024 numbers, and then you sum it all up, the aggregate tariff rate would be about 21%. Now, even though a bunch of countries got cut from very, very high tariff rates, almost up to 100% in some cases, to 10% across the board, except for China, Canada, and Mexico. China getting 125% total, Canada and Mexico 0. They still have sector-specific tariffs that impact them. We'll come back to that. But if you just take those sort of country-level tariffs, we went from 21% last week, which was viewed as catastrophic, horrible, to 23% today, which was viewed as a massive relief. That may sound kind of crazy. In the short term, though, I think it's pretty rational. And here's why. The spectrum of outcomes that you could get where the Trump administration said, we don't care at all what happens to the market. We're just going to keep doing what we're doing. We know better than the market. The market doesn't know anything. We're going to keep going at it. The distribution of outcomes there gets really bad really fast. Like financial markets breaking down entirely, not just stocks dropping, but stuff stopping trading. Great Depression level economic activity hits. Though that is on the spectrum of outcomes. By stepping in and saying, okay, we're going to walk some of this back, the Trump administration is admitting that they don't have the juice to run roughshod over the market. They're not going to ignore the market entirely. And so that cuts off a bunch of really, really bad outcomes. It doesn't mean that you can't have bad outcomes. It just means the really, really bad outcomes that are sort of now what is called the left tail, the worst of the worst. Those are now not likely or impossible. And so if you've got a distribution of outcomes and the bad stuff goes away, then the median or the weighted average outcome must be higher. And so stocks ripped. Now, we're still going to probably have a recession. We are still going to have a lot of economic pain from the tariffs on China, specifically. The auto tariffs, which do impact Canada and Mexico, those are going to be a problem. But the worst of the worst case scenarios are now shaved off. And so from that perspective, it's perfectly rational for markets to be higher. Now, if the S&P 500 goes to 6,000, it closed today at 5,200, I think. That's a different story. It closed at 5,450, give or take. If we go to 6,000, I'm not going to be saying this is rational, but as a one-time thing, big narrative shift, big change in the distribution of outcomes, I think it makes perfect sense.
Right. Like it's rational until the time that Trump is expected to respond to markets and he doesn't do that. Right. Yeah.
100%. But he's now shown, I'm going to respond. So, yeah, you're updating your priors. Markets are constantly saying, what do we know? And what's the new information?
It's like
and
Bayesian,
price is, yeah, exactly. It's Bayesianism. It's always Bayesian. And I didn't want to drop in that term without.
It's all right. Yeah. Well, but tell our audience, go ahead. Tell them.
Yeah. So Bayes basically argued that you should have a set of beliefs about the world that are based on evidence. And as you get new evidence, you need to update your views based on that new evidence. That sounds like a really simple thing, but it's really hard for a lot of people to do. And in markets where prices are set on the margin, that incremental, in other words, like the US stock market's market cap isn't what everyone could buy the US market for. It's whatever the marginal person is willing to pay, extrapolated out. Prices being set at the margin mean that small changes in information can yield huge changes in price because of that forward-looking Bayesian approach that markets take to new information. They are always forward-looking, and they're often wrong. That doesn't mean they're always right. It just means they have a specific way of updating when new information hits.
Maybe we could talk a little bit about the bond market. I think this gets quite a bit less attention in, popular media. But there was something that happened Tuesday where the price of treasury bonds, U.S. government debt, especially the 30-year, I think the 30-year just spiked up to like over 4% or something like that. Very unusual, especially during a time of, market uncertainty. You would expect to see the obvious opposite, where people are piling in to buy these bonds and driving the interest rate down. And some have speculated, Adam Tooze had a post on this, saying that it might be related to the basis trade.
Yeah, it wasn't the basis.
What was going on there?
Going around a fair, but I can explain. Yeah, what the basis is. Well, I can explain it as best as everyone listening to this is willing to hang with me for a second. I promise we'll get there. This is nerd stuff, folks. I'm sorry. I'm going to have to do this to you.
Our audience, they're nerds. They're patient. They got it.
Yeah. I got to give that disclaimer. If you are looking to just vibe out on a sunny Friday afternoon right now, maybe save this one for another time. Okay. So, what is the basis? The basis is the relationship between treasury bond futures and treasury bonds themselves. A futures contract is a contract that is an agreement to buy or sell at a determined price in the future. So if I'm long a future, I'm agreeing to buy a given thing in the future at whatever the price settles at. So for instance, if I want to buy a barrel of, it's more than a barrel because these are big contracts, but if I want to buy a barrel of crude oil, I can go out and get long the future, buy the future. And I now have the right to accept delivery of crude oil in the future. Side note, if you are ever in the position where you have to accept delivery of WTI crude, you are in a world of hurt. You've done something terribly wrong. Someone screwed up. That should not be possible.
Hope your warehouse is big.
Yeah. The vast majority of futures contracts are either financially settled, i.e. they're just traded in, they're settled on a dollar basis, or they are closed out. The trade is longs and shorts buy and sell from each other and net out to zero before they actually settle. So a bond future is kind of interesting because there are small differences between a bunch of different bonds. A treasury bond that's maturing on December 31st of 2032 is going to be with a 4.5% yield, is going to have slightly different characteristics from a treasury bond maturing on December 31st of 2033 with a 5% yield. They're not going to be the exact same thing. So there is a procedure that basically says you can deliver any bond within a given set of parameters into this futures contract to settle it at the end. Because there's a pool of different things that you can deliver in, you get what's called optionality. So you can go in and find a bond that is easier to get a hold of to hedge that futures contract with. The difference between the bond price, the cash bond price, the actual bond that trades, that's a direct, like you receive interest payments from the treasury, you'll get paid out your principal payment from the treasury at the end, and the futures price, that difference is called the treasury basis. It's a spread that you can trade. And I was actually talking today with the colleague who got me connected with the guys who have employed me for the past decade or so. And he is a basis trader. That's like literally all he does. His whole job is navigating the spread between these cash bonds and futures. This activity is very highly leveraged. Treasury bonds don't move around in price that much. So if you want to make respectable returns, you need to borrow a bunch of money to turn what is a not volatile thing into a volatile thing. Doing that carries risk, but as with anything, if you are able to manage the risk, then leverage can be very helpful. It's not like borrowing to make a return stream more volatile necessarily is a really bad idea. It just depends on how good you are at managing risk. There have been some very, very large examples of people doing this poorly in the past. If you're a real financial markets nerd, you might have heard of long-term capital management. It was one of the biggest hedge funds in the world, and it had incredible returns for a long time, collapsed and required basically a bailout from Wall Street banks in September of 1998, was part of a broader financial markets panic related to emerging markets debt and some other stuff. So they were doing stuff called fixed income relative value, which the basis trade is part of that. The basis trade is viewed as a big problem in part because it's very large. Like the numbers are really, really big. We're talking hundreds of billions of dollars on either side of this thing, and extremely high leverage. It's also sort of one-sided. A lot of hedge funds will seek to use this trade in a way that takes advantage of other market participants wanting to be on the other side of it. And so you get kind of the same pools of investors on either side of the trade. You get crowding, this is called. And so you see big numbers, high leverage, crowding. It screams risk. And I think it's understandable why people would think it's a risk. The basis actually in the last week or so has been pretty well behaved. It's moved around, but you haven't seen this sort of huge price movements in that spread between cash bonds and futures that you would expect to see if this was like a trade that was blowing up and everybody was getting crushed. You did see that in other fixed income relative value trades. We don't have to get into the details of what this means, but swap spreads, treasury butterflies, both good examples of trades that looked really painful for somebody. Like, in other words, it's a nice smooth line and then it moves a lot. And that's a sign someone's getting crushed. Basically, someone is being forced to sell when they don't want to, and that's making the price dislocation worse, and that's forcing other people to sell. So we definitely saw dislocations in the bond market. The basis trade, in my opinion, based on how it traded and based on where it priced over the past week, I don't see a good reason to believe that it was the driver. I think other stuff was going on, and it was just general, similar to the stock market, just general people were facing big losses and had to sell stuff to stop the bleeding. And, so with all due respect to Adam Tooze, I think he missed on that one.
Let me see if I can summarize this real quick, to give me some rope, as they say in, that one movie, Margin Call, the dim-witted, CEO. No, so like you have the market for treasuries, like the actual bonds that you can buy, and then you own them, and then you get the coupon payment from the government. Then you have the futures contract, a contract to buy or sell those bonds in the future. And if you're a whiz-bang finance nerd, you can find little bitty differences that would give you an advantage in the price between those two things, in various ways. Just intentionally being a little bit vague because I don't, pretend to understand it very well. And then we're talking about pennies on the dollar. And so you borrow, if you want to make lots of money,
pennies on the dollar.
Yeah.
Like this sort of stuff is generally measured in basis points, which are 1/100th of 1%.
Yeah. And so if you want to make a lot of money, you borrow 10, 50, 100 times your capital that you're putting in. You make this trade, and you gear yourself up big time. And that's how you actually make a decent profit on this. And the problem, I think, we saw in the pandemic, in 2020, when that hit totally out of the blue, there was a problem with the basis trade, as I recall. And a lot of people had to sell all at once, and it messed up the treasury market.
Yep.
But you're
exactly.
saying,
so you basically saw in that period, you saw the cash price of bonds and the cash price of bonds and futures go in opposite directions. And so what was this tight spread blew out. So the spread was really big. This time the spread moved in the opposite direction from 2020. And it was also, it's been moving in that direction for over a year now. These trades move both slow and fast depending on market conditions. But so in 2020 we had, imagine You're looking at a nice smooth line. In 2020, it spikes up huge. This time around, it's dropped, but not dropped that much. So that's why, to me, I think the basis explanation doesn't make sense. It doesn't really fit the facts.
Gotcha. Yeah. So it was just people selling off assets for whatever reason.
Yeah, I mean, in any market, if you are stuck with a portfolio full of stuff that's hurting, and you need to raise capital to meet a margin call, or just to make sure you have cash on hand in case your investors want something back, or maybe you want to go buy something that's gotten really cheap, you're probably going to sell the stuff that's up a lot, right? Because not always, but you're often going to sell the stuff that's up a lot because that you can book gains there and feel good about that. And if you entered a trade that has now moved against you, well, that just looks more attractive as opposed to something that's already done really well and you can now liquidate. And so I think a lot of these bond market dislocations were driven by that dynamic where stuff that had been a big winner for people suddenly moved really hard the other way because only it doesn't take many portfolios getting, using that as a source of liquidity. And now suddenly everyone's being pressured and they're trying to get back their, or trying to protect their gains. And it turns into, oh, now I'm big underwater and I got to clear out of this trade. It's amazing how quickly something can go from a winner that everyone's long and done well in to a complete loser. And that's especially true when everything is dropping in price, which was the case over the past week.
Got it. Okay. So we have some goofy shit going on in the markets, but it's nothing, so far as we can tell, that's utterly insane. But maybe we can zoom out a little bit and talk about the broader kind of macro dynamics of, trade deficits and the economy writ large. Before we started, we're planning this episode, you recommended the book, Trade Wars or Class Wars. I think it's a great book by Michael Pettis, an economist in China, if I recall, and Matthew Klein, who's a financial reporter. I've cited it before in my articles, but what prompted you to recommend that book? And what do you think it shows about the current situation?
Yeah, so I think that book best and most succinctly describes the system of global imbalances that have created the conditions for our current moment. What do I mean by those imbalances? Okay. Any country that is exporting more than it's importing or importing more than it's exporting, they have to be either borrowing or selling assets equal to that amount in a mirror image. Think about this in the context of a household. Using a household is a rough way to do analogies in macroeconomics, but it does work in some instances, and this is one of them. In a situation where a household has $1,000 of income and wants to spend $1,200 to take in more stuff, right? You have to get that extra $200 from somewhere. You can spend it out of savings. You can borrow it from your credit card, but it's got to come from somewhere. Conversely, if you have $800 worth of spending and $1,000 worth of income, you must be acquiring an asset with that, depositing it in your bank account, or maybe paying off an existing debt. But either way, your net assets are going up. So that difference between income and spending in the world economy, for most countries, most of the time, is not a huge thing to be super concerned about. Countries will run trade surpluses and trade deficits that shift from time to time, depending on a whole bunch of factors. As long as they're not too big relative to a given country or the rest of the world economy, then we can basically ignore them. They're not particularly important. The problem comes when large economies run large surpluses or deficits. In the case of China, that is a current account surplus. Current account is trade balance and then income, but most of it comes through trade. China produces enormous amounts of stuff, and they don't consume that much stuff domestically relative to what they produce. They also don't consume that much stuff from the rest of the world, again, because they don't consume that much domestically. The result is they have this mountain of stuff that piles up and that they need to sell. That huge pile of excess income over spending has to work its way into either lower debt versus the rest of the world or more assets versus the rest of the world. And That means that China essentially has to go buy stuff, financial assets or ownership in something, to balance mechanically all of the income that they're piling up. This is like it's called an identity in mathematics. It's assets equals liabilities plus equity is what it is in accounting. It's the exact same thing for global imbalances. If you have large surpluses of income, generally through goods trade, but it's generally through goods trade, and that's the case with China, then you must be acquiring a bunch of assets somewhere. And that combination means all sorts of distortions. It means that China's got a much weaker currency than it otherwise would, because it's buying a bunch of assets from the rest of the world. And that buying pressure essentially is keeping China's currency low. That means households in China can't consume as much from the rest of the world as they otherwise would. They're poorer than they otherwise would be. And it means that on the flip side, here in the United States, our dollar is too strong. Our foreign demand for our goods is too low. And we have a current account deficit. We spend more than we earn from the rest of the world. And that is the one thing in the Trump administration's theory of trade and sort of milieu that really is true. Like there are imbalances that are problematic and need to be sorted out. The problem is how they're going about it. It's been incredibly disruptive and probably self-defeating, honestly. But there is a kernel of truth in there that the imbalances that are driven by that massive excess production of China's economy is not matched by domestic consumption of their output.
Yeah, the U.S. has kind of been the consumer of last resort for a long time. Pettis and Klein, they talk about the exorbitant privilege of the dollar, and they call it, in fact, an exorbitant burden. I tend to think it's kind of a mix of both things, because it gives the U.S. government immense power to have control over the financial pipelines, the ability to apply sanctions and stuff, because everybody has to use the dollar. Everybody has to interface with the U.S. banking system. And so we can beat the crap out of Iran if we want to. But yeah, as you say, the effect is that here in Wilkes-Barre, Pennsylvania, we just flushed down the toilet, 50 years of industrial capacity that we, spent, building up over time, all the steel mills and factories and so on. Yeah. I mean, it seemed to me that Biden was trying to address this in a more sensible fashion, trying to kind of rebalance the global trading system, in a more sort of sensible fashion. Basically just saying, okay, we can't just keep gulping down everybody's surpluses forever. It's having toxic effects. Look at Trump. That arguably comes from deindustrialization. Do you think that Biden's approach was the right one? Or, what would you do aside from just declaring trade war on everyone and then undeclaring it at the last second?
Yeah. So the Biden approach was much more long-term. The idea from the Biden administration was, we're going to keep on some tariffs on China, but we're going to do that strategically. We're not going to tax consumer goods, but we will tax, or we're going to tax consumer goods much, sort of reasonable levels, not 125%. But we're really going to focus on preventing China from developing an insurmountable lead in specific nascent industries. We're going to protect what are called infant industries. So this is solar, batteries, EVs. The idea was looking forward 20 years and saying, what are the industries that are going to drive a large share of the global economy, and how do we prevent losing out on those? There was also a ton of focus on preventing China from getting to the cutting edge with AI that was mixed success. Again, with the idea that we're going to protect our ability to be a leader in that nascent industry. I think certain kinds of free marketeer would look at that and say, well, why are you picking winners and losers? Why are you trying to decide which industry is going to be the best one in 20 years instead of just letting the market figure that out? The problem with that is that China doesn't think that way, and they use tremendous levels of subsidy across a bunch of different policy levers to make sure that the playing field isn't level. This is not Chinese companies competing against American companies. This is Chinese companies, or not just American companies, the whole world. Right now, Indonesia is dealing with a complete collapse of their textile industry because China has moved in and started to dump imports on them for very cheap. A more happy version of this is Pakistan, where solar cells are so unbelievably cheap that they're basically skipping grid electricity and going straight to solar electricity, which is a great outcome given how terrible their grid was and how the effects it'll have in terms of decarbonization. But for the world as a whole, dealing with China as a unfair competitor is really difficult. And the Biden approach was to be more incremental and to use subsidies and planning as well as tariff barriers, which were much, much lower, largely holdovers from the first Trump administration. And to sort of allow a transition away or allow a specialization in relatively low value manufacturing for China, as opposed to being super, super aggressive. The Trump administration approach is just, if you tariff it enough, it will solve itself. And that's just not how any of this works.
Well, can I ask too, because the book seems, it's trade wars or class wars, and it seems like a thesis of the book or the solution the book offers is that it's not that there are countries that have economic interests that are against one another, but that everywhere the elites have interests that are contrary to everyone else, right? And that, it's the problem with China. Part of the problem is that a lot of the people are poor, and that's why they can't consume enough things, right? And so they say in the long run, reducing inequality everywhere is the important goal. And then in the short run, I think they said more government debt for us, and a few other things like capital controls and the Federal Reserve doing something about swap lines. So what are your thoughts on their thesis, long and short run? Maybe you could explain that a bit and say what you think.
No, that's 100% right. Earlier, I mentioned that China underconsumes. That is not a cultural thing. That is not Chinese people, those silly Chinese households not saving or saving too much and not spending enough. Like, we need them to change.
It's Confucius. It makes them more conservative,
Exactly. That's all complete nonsense. Not true at all. What it is a specific set of policies that the Chinese government has undertaken to subsidize production. The Chinese Communist Party is no longer communist by any stretch of the definition, but they've retained some of the intellectual holdovers from communism. One of those is an extreme focus on production as opposed to consumption. So from the Chinese perspective, if you produce like all economic attention needs to be focused on production. And to do that, we need to subsidize those producers. We need to make labor very cheap for them. The Hoku system is a really good example of this. If you are not from a given city, if you do not have what's called a Hoku permit to live in that city, you don't get access to a bunch of services in that city. You don't get access to the same rights that the people that have those permits there have access to. And so that's enormously detrimental to labor bargaining power, of course, right? If I can't just say, oh, this is not a good opportunity, I'm not getting paid enough, I'm going to go over to Shenzhen from Beijing, or I'm going to try my luck in Wuhan, whatever the case may be, you are giving a huge subsidy to the people that need to buy labor. It's really similar, honestly, to the U.S. labor market dynamic, where we have a large percentage of not enormous, but a measurable percentage of the labor market that is undocumented, and employers have bargaining power over them because those people don't have the same rights that all citizen workers have. That suppression of household income through lower bargaining power. There are other examples in terms of direct subsidies, financial repression, which is basically paying too low of a interest rate on deposits for investment, as opposed to in order to pay lower or charge lower interest on loans for growth of production. That's another example. There are a litany of them. This is Chinese government policy immiserating its people, and doing that as a way to develop economic output and maximize elite outcomes. It looks very different from how the United States policy sphere operates when it's at its worst. But the effects are the same, which is to say high and rising inequality and fundamentally like a series of human rights issues that are just not conducive to stability across society. There are other countries that have taken similar tacks. So for instance, in the Eurozone, the Pettis and Klein book is very critical of the Hartz labor market reforms in the early 2000s.
In Germany.
In Germany, yes, thank you. There are all sorts of criticisms of the lack of support for consumption that the Eurozone and led by Germany undertook up until literally this year. So it's not, I think they're exactly right to think about the challenges of the world as challenges of inequality and challenges of inequity that represent different approaches from different governments to the question, how do we bolster our elites' outcomes? And the policy solutions there are going to depend on the political systems they're embedded within. I think for China, we may be getting to a point where where it becomes impossible to imagine further growth under their current system. Whether Xi Jinping is a flexible enough thinker to actually pull that off is an open question. But the current way of growing, which is to subsidize domestic producers, suppress domestic consumption, and push surpluses onto the rest of the world, is hitting its limit. The Chinese economy used to run a large trade surplus versus emerging markets, and a relatively small trade surplus versus frontier markets. Over the past 2 years, that's shifted to a pretty significant trade surplus versus emerging markets. So this is other relatively undeveloped economies, and versus frontier markets, which is sort of the next tier down. We're talking about enormous trade surplus, larger than that with the United States. So they're running out of places to go and push this excess production, and eventually the rubber has to hit the road. It hasn't yet, but the hope is that eventually China can get to the point where political reform will allow the sort of labor market bargaining power for households and consumption growth that is necessary to rebalance the global economy as a whole.
Yeah, it's funny. You read like interviews of Xi Jinping and he sounds just like Joe Manchin. He's like, he's got austerity brain, it's like, you don't need to consume more, you need to work more. And the Soviets were the same way, he who does not work, neither shall he eat. That was in the Soviet constitution. It's funny, reading that book several years ago, you think like, geez, China, this seems like a pretty simple problem to solve. Like, okay, the rich people are taking up too much national income, like just redistribute, just like give poor people some money. They'll love you for it. And, you can that your own people can buy all this shit that you're making. Like, isn't that why you get in the game of economics in the first place? Isn't this why you get, rich? Like, what are we doing here? But then, during Bidenomics, we saw a pretty substantial decline, something like 30%-ish of wage inequality, the tightest labor market in generations, especially for the very bottom, massive increases for the bottom, a couple of income quintiles for wages. And it led to a stupendous political backlash. Rich people fucking hated that. They went crazy and donated billions and billions of dollars to elect Donald Trump. And maybe that kind of brings us back to the, like the current situation. You could sort of speculate maybe China will figure its stuff out, but how do you see, the American context, like in terms of, these type of dynamics that you're talking about with China, and the prospect of, kind of assembling a coalition around, democracy and production and consumption, and not like the most, syphilitic emperor trade regime of all time.
Yeah. I mean, one thing we can say about the Trump administration's approach is that it's not going to create any coalitions. That's very explicitly the opposite of their goal. They want to be negotiating bilaterally. In other words, one-on-one. They want to I mean, if you read the speech published by Stephen Mirren, who's another senior advisor to the president on economics earlier this week, he talked about a system where other countries should just be giving us money because we have a strong military. It's explicitly protection racket stuff. It dressed up as global macroeconomics. I don't necessarily think that we'll get to the point where we'll have an actual protection type scheme going on where we're going around and invading countries until they pay us something. But it's not hard to see getting there. And I don't see a world where there is any international coalition that cooperates with the Trump administration on anything as long as this sort of attitude persists. There may be lots of instances of the United States entering into a negotiation with another individual country or group of countries like the EU, which obviously they kind of have a unifying structure. So you could argue that's coalition. That's not what I mean. I mean, I'm talking about groups of sovereigns, not a sovereign that's had aspects of sovereignty delegated to it. I don't see a way to coerce or convince China to alter their domestic policy in this environment. And they may get there on their own anyways, and that's sort of the hope. But I am not optimistic that comes from anything the United States does.
Can I separate out two things from Trump and his administration? Because I think he made a good case about how unsuccessful what he's attempting to do will be in terms of getting what he thinks is going to happen. But I want to try to understand how confused and in what ways he's confused about, like, even if he got everything he wanted, what would happen isn't what he thinks would happen, basically. And we could go back to, like, he confuses trade deficits or trade surpluses with the tariffs that other countries have on us and that we have on them. Like, can you explain for the audience, like, the basic confusions that he seems to have and how that relates to his tactics?
Yeah, absolutely. So, well, what's a trade deficit? A trade deficit is me selling less stuff to you than you sell to me. When that happens, when I buy stuff from you, I'm not just giving you money. I'm getting something in return for it.
What?
Right? Yeah. Like, so there are, as we discussed with China, there are situations where persistent trade deficits, either bilateral or in aggregate, can have negative outcomes. And there is such a thing as harmful global imbalances. But the scale and the specific source of a bilateral trade deficit is really important to understand. And there are very few countries in the world where the United States runs a large trade deficit that is driven by their domestic policy or by something that we can compel them to change. A really good example is bananas. We're just not going to ever grow as many bananas in the United States as we want to eat. Never going to be the case, right? That doesn't mean every country where we run a trade deficit in bananas is screwing us over. What it means is we need to be able to give them something they want in return. And right now, that is our financial assets, not just treasury bonds, but all kinds of dollar-denominated financial assets, stocks, bonds, corporate bonds, bank deposits, mortgage-backed securities, you name it. The reason for that is the strength of the dollar, and the strength of the dollar is being driven by other global imbalances, as I sort of laid out earlier on. But going after Lesotho or going after even Honduras or another small country in the Western Hemisphere that we do a lot of trade with, that is not going to change the macroeconomic imbalance. It's irrelevant because the large current account deficit that the United States runs and the strong dollar are not caused by the actions of Honduras. They're caused by the actions of other larger blocks around the world, mostly China, to a degree, places like Japan, South Korea, the Eurozone. And trying to tax bilateral trade deficits is just going to move them around somewhere else. It's all it's going to do because it's not addressing the root problem.
So if I can, Trump, at least he talks as if it's all about negotiating toughly because someone is just taking advantage of you unless you push back and are tough. And everyone's just getting as much leverage over everyone as they can. rather than understanding the structural reasons that people are doing what they have to do that have involved things like competitive advantage and the fact that like it wouldn't make sense for us, given our resources and given the strength of our dollar and so forth, to do things that like poorer countries do. Can you explain like competitive advantage and how that plays into things?
Yeah. So comparative advantage is just the idea that certain countries are able to do stuff more efficiently than others. A really good example is the banana one I just used, right? Like we just can't, or coffee. We can't grow coffee in the United States. You can't do it. It's not physically possible. So we will always run a trade deficit in coffee. Now we run trade deficits for a bunch of reasons. It's, if you just look at goods that we purchase from overseas that can't be grown anywhere else, or can't be grown in the US, that doesn't fully explain it. So I get why people confuse the comparative advantage thing or sort of think, well, the comparative advantage thing is only a tiny share of goods. Yeah, but it extends beyond that. Have y'all ever sewed a shirt before?
Not me.
No.
Ryan was the more likely of the two of us to say yes to that.
I've repaired a shirt and pants. When I was in the Peace Corps, I did some highly amateur sewing.
He was very self-sustaining in the Peace Corps.
I've never worked in a textile mill, if that's what you're asking.
Sewing is, I have immense respect for people like my mother who are capable of sewing clothing.
Fine motor skills, right? Yeah.
Fine motor skills, exacting attention to detail, and it's slow. I mean, even something as simple as crocheting a water bottle sling. A friend of mine who I do. Yeah, patience and practice and meticulousness, right? These jobs are not fun to do. They're not. They're not fun to do because they require enormous focus. They're very fine motor. They are boring. They're incredibly boring. And they have to be done at such a large scale to make the production worthwhile that you're just not going to have Americans do them. And that doesn't mean that we can't do more manufacturing here. It just means a certain kind of manufacturing is not going to fly here unless you are literally forcing people to do it, which given the near riot we had over egg prices in 2022, I don't think that's going to fly. So what are you left with? You're left then with either not consuming something or producing it overseas. And for those overseas countries that are doing textiles, for instance, that's a really good way to get onto a growth arc, right? Because you're getting used to the idea of organizing capital, organizing labor, building out supply infrastructure, doing logistics, doing the sort of basic stuff in a market economy at scale that lets you do more complicated stuff down the road. There's a reason that so many countries in East Asia were able to jump from relatively low-end manufacturing to relatively high-end manufacturing. So think about jumping from assembling toys or assembling shoes or assembling textiles to making advanced semiconductors, right? That jump requires a lot of experience and careful planning and reps, basically, doing this stuff. And it is really hard to get people to do the early manufacturing stages if they already have an economy based around the higher value added stuff, because it sucks to go backwards. You're not paid as much. You're not as productive. You don't do things that are worth as much. And it's also physically boring and not great. So unless your solution, which admittedly some on the left do favor, the degrowther bunch are an example of this. Your solution either has to be consume less, degrowth, or let countries specialize in doing these things that we are not going to do here, that you can't convince Americans to do for a wage that will actually render a product at a price that someone actually wants to buy. Those are sort of your only solutions.
There was, do you remember there was a big Twitter thing among the leftists about bananas, if you recall this? It was about like, it was hilarious actually, but honestly, it was basically like a communist saying, look, under communism, you can't expect to get a cheap banana at 7-Eleven like every day. That's not going to happen. And that, I think, is what you're saying is like that would you would consume less bananas, right? If you want communism, because like to have a real egalitarian society, like you can't make poor people, where they grow bananas cheaply in the conditions that are necessary to have it over here cheaply. Like that whole supply chain thing, like if you want that to happen, then you're in favor of certain kinds of exploitation and people living in poverty in places. And we don't want that, right?
Yeah. Yeah. I mean, I think it's nice when folks that take that tack actually admit that, like, oh yeah, we want lower standards of living. Like, we want you to have a worse, like, we want you to eat stuff you don't want to eat. We want you to have less choice. We want you to, which, I mean, look, I mean, I'm not here to tell people what they should or shouldn't believe in terms of what the best layout for society is. But what I will say is that's, you're going to have a hard time getting that particular political ball up the hill. And that is exactly where we're going to get with the trade stuff. And especially with 125% on China, tariffs on China, an enormous volume of stuff is just no longer going to be available. Right? Like, you are not going to be able to buy a lot of consumer products that you have been able to get for years. I am, for my sins, a TikTok user. I'm moderate about it, I promise. And
could quit anytime.
That's one reason none of us are crocheting anytime soon. That shit's going to fuck up our attention span in a heartbeat. It's no way.
Exactly. And I use TikTok as thoughtfully as I can. But one thing I notice on there is just the ocean of stuff that's sold through the TikTok shop, right? The ad load on TikTok is wild, and it's all totally useless crap. I have bought some of it. The only stuff I would recommend is like some of the Korean ramen that I've gotten. It's been great. That's been fine. But like everything else I've gotten, it's crap. It's crap. That's going away. And the modern day American Maoists in the MAGA movement that think that, oh, well, you don't need that stuff. They might have a point. You know, the degrowthers might have a point that, like, you know, we'd be better off if we didn't buy all this stuff. But people want to buy stuff, and telling people that they don't get to buy it, they don't get to have their treats when they want it, it's tough, man. It's a tough political sell. Whether you're doing it
for me, that's not even, at least if leftists, I don't think we have to do the degrowther thing, but at least they're trying to advocate the trade-off of that is like reducing inequality and giving everyone the necessities of life. Like, what's the vision of the MAGA people? Is like, what's the trade-off? So we don't get 100%. All the stuff and what? And like, what, you know, we're going to, I mean, just have higher cost of living. Like, what's the trade-off for that? I don't know what their approach they're taking. What are they trying to sell us on exactly? Right. And, or where are they wrong and what they think is going to happen?
I think it's very
maybe
simple.
It comes down to just performance of gender at some point, right?
Yeah, no, you don't, you know, the social contract where you don't get a union and you don't get a real welfare state and you don't get a union job, but in return, you get access to endless quantities of Chinese garbage on, social media and Amazon. That's going away. And in return, we're going to have a massive recession. Unemployment's going to go up a lot. And all of the corporate bosses will get prima nocta on all of their female employees. That's the bargain that is offered to us today. I mean, this, you know, maybe in a little more seriousness, like, we could maybe close out on like the uncertainty question and where you see the kind of economy going. Cause this seems to be like the big question mark. Cause, you know, you look at like what fraction of the economy is trade with China in the US and what fraction of the economy in China is trade with the US. And, you know, it's not that much, but like the way that Trump has behaved, I feel like is like businesses across the board, there's indications that they're pulling their horns in. Consumers are the same way, putting purchases off. I'm definitely feeling this way. Like, you do, and that's a very self-fulfilling prophecy type of dynamic, you know, where it's like less spending, and then so there's less income at businesses, and then they lay people off and rinse and repeat. So what do you think about like the American sort of job market and macroeconomy over the next year?
So the way to think about the economy is to think about it as a big ball of stuff rolling along. It's got momentum to it. When consumers are earning income, that means they have income to spend. When they spend, more people earn more income. When companies are seeing their bottom lines grow at a healthy pace, they get more confident, they invest in more capacity. That means more income for people, which means more spending, which it's a virtuous cycle,
when in economics and macroeconomics, we talk about when this ball is rolling, it's in equilibrium. In other words, there's a steady sort of a growth rate. You bounce around that growth rate, but you're growing at, let's say 2%, 3% per year, in real terms, adjusting for inflation. So maybe 5% without an adjustment for inflation. The problems tend to come when something disrupts that momentum. That disruption can be something geophysical. So for instance, the COVID pandemic was the perfect example of what's called an exogenous shock, something that comes from outside the economy and breaks the cycle. Suddenly people aren't spending, which means people aren't earning, which means companies aren't getting new customers, which means investment goes down, which that's a recession. That is a collapse in the business cycle. We dealt with that through policy, which was another exogenous shock, a positive one in this case. We gave people lots of money and eventually they spent it and the economy roared. So where we are right now is a relatively dicey point in the economic cycle. Consumer incomes are growing at a healthy pace, call it 5%, 6% annualized, depending on the measure you look at. That's before inflation. And that means that consumer spending has held up okay. The first 2 months this year were weak, but that looks like it was mostly driven by weather and a bad flu season. If it weren't for tariffs, we would expect March to be very strong. March may end up being very strong from people running to go grab stuff before the price goes up. But we are about to see a bunch of economic activity no longer pencil out. What do I mean by that? If I was a company who can only source goods from China, and there's, I don't know, maybe not millions, but thousands, hundreds of thousands of examples of this, where the only place you can buy what you need to buy to keep your company operating is in China. If you now have to pay more than twice as much for that input, whatever it is, it doesn't matter if it's 10% of your cost of goods sold or 70% of your cost of goods sold. If you have to double that, you're going to have to either raise prices a ton or just not operate anymore. And the magnitude of the tariff is so large that a lot of people will just choose not to operate anymore. You're seeing this anecdotally, where people are being told your shipment from DHL you expected to pay $3,000 for is actually $5,000 or $6,000. And that's the end of it for that business. I can't pay that. I'm done. That's it. Over. That sort of shock is what can turn a relatively stable cycle of virtuous cycle of more income, more spending, more income, more spending, more investment, into something different. And it doesn't take that much to knock that off its foundations. Consumers are relatively healthy right now compared to history in terms of debt level, in terms of housing wealth relative to housing debt, in terms of debt payments relative to income, in aggregate. So if we didn't have this shock, we would expect the economy to keep rolling along. Instead, I think we're in a pretty dicey spot. The percentage of people that are getting hired, fired, or quit every month is very low relative to the past 10 or 12 years. And that means that relatively small changes in demand for labor could lead to a big change in the unemployment rate. Imagine a bathtub. That's the unemployment rate, is the amount of water in the bath. Right now, the drain is not open very wide. If you suddenly crank on the faucets, it'll overflow really quickly. And so that's sort of where we're at with the labor market right now. So I do think we'll see a recession start this year. It might not start until towards the end of Q2. It might start a little bit earlier than that, but I do think we'll see a recession. I think we'll see the Fed being forced to cut interest rates despite high inflation. And I think that we'll see unemployment spike quite measurably. For most of my career, have been a perennial optimist about labor markets and the economy. So this is rare for me to be saying stuff like this, but that is, I think, where we're at.
So is stagflation a risk then, or?
Depends how you define stagflation. Very controversial term in macroeconomics. I think what most people think of as stagflation is slower growth with higher inflation. In reality, it means like rapidly rising unemployment with higher inflation. It's very rare. We've only seen it in one real period in the United States since the Second World War, which is the 1970s. it was because of a huge amount of cost push inflation. So in other words, a very large price shock for oil meant that people's inflation expectations became unhinged. People expected more inflation, and that created more inflation. That's what the Fed is going to be watching. If we get a situation where economic growth is slowing, unemployment is rising, and people think that inflation is going to continue trending higher, that's going to be grim, because then the Federal Reserve will have to raise interest rates with rising unemployment as opposed to cutting them with rising unemployment. And that's when you're talking about 6, 7, 8% unemployment as opposed to 5 or 6% unemployment. We'll see. We don't know exactly how the economy and how inflation expectations will respond to the very large kick that has been delivered from the Trump administration. And it's possible that we see very, very aggressive inflation this year that sort of feeds on itself. And it's possible that we see prices go up due to the tariffs and then inflation slow because the economy is very weak. We just don't know. That's going to be the question.
Well, that's a pretty good place to stop, I think. George Pearkes, thanks for coming on the program.
Thanks for having me, guys. It's a pleasure.
Yeah.
Appreciate it.
Maybe you can come on someday when times aren't so dire.
Yeah, maybe give people like, here's how to invest your for retirement kind of thing. That might be a little bit more cheery.
That's right. There is a future, folks. You can have one.
Yeah, everyone loves hearing about that, especially on TikTok. But anyway, thanks for listening, everybody. We will see you in the next episode.